Welcome to the Contrarian Investor Podcast. We give voice to those who challenge a prevailing sentiment in global financial markets. This podcast is for informational purposes only. Nothing on this podcast should be taken as investment advice. Guests were not compensated for their appearance, nor do they supply payment in order to appear. Individuals on this podcast may hold positions in the securities that are discussed. Listeners are urged to educate themselves and make their own decisions. This podcast episode may have ads and the occasional announcement. To listen without ads or announcements and take advantage of a host of other benefits, consider becoming a premium subscriber. Visit the website contrarian.supercast.tech. That's TECH for more information. Now, here's your host, Mr. Nathaniel E. Baker.
I'm here with James Fishback, co-founder, CIO, and head of global macro at Azoria. Azoria is, I believe, a new firm. We're going to talk about that later. But I'm very pleased to have James on the podcast today for a number of reasons. We'll get into all of them. But to jump off with our most contrarian take first, the Federal Reserve is about to start its monetary loosening and is likely going to cut interest rates at its next meeting, which is in mid-September, I guess. And now the market is starting to price in a cut of 50 basis points at this first meeting, and then having a total of 200 basis points of Fed rate cuts when all is said and done. James here isn't buying it. Tell me why.
Well, Nathaniel, it's good to be here on the podcast. I love the way we started off, right? Just jump right into an inconsistency between what I think markets are priced and where I think things will materialize. So the Fed historically, look back the last 30, 35 years, the Fed has only done two types of rate cutting cycles. The type we'll most notice are 2000, 2008, and 2020. The Fed aggressively took rates to zero or awfully close because there was a major negative economic shock. In 2008, it was the housing crisis. In 2020, it was a novel coronavirus. Now, the other side of the rate cutting cycle is not this aggressive move back down to zero, but what the Fed typically calls a mid-cycle adjustment, Nathaniel. And that's a tinkering. It's a calibration of policy, usually 75 basis points or so, because the Fed doesn't necessarily see an imminent negative economic risk, but it wants to bring their policy better in line with where the risks might be. So no, not a shock right here, right now, but there could be some things brewing down the pike, and we might want to adjust policy a little bit to get ahead of that. And so the most recent example of this was the summer of 2019. There was a trade war, there was some manufacturing weakness. And so what did the Federal Reserve, led by Jerome Powell, do at the time? Well, they cut 75 basis points. They cut at the July meeting, the September meeting, and the October meeting. They called it a mid-cycle adjustment. And what they also did, Nathaniel, is they framed those cuts in line with what they did in 95 and 98. And so as a studier of the Fed, one thing you'll know is the Fed is really big on past precedent. They're really big on the historical playbook. They often think about their moves today and how they might have mirrored moves in the past. And so I look at the economy. Everyone's talking about when's the recession going to come? When's the recession going to come? Well, there's two answers to that. One, we already had a recession. We already had two back-to-back quarters of negative GDP growth in 2022 on the back of the most aggressive Fed rate hiking cycle since a guy named Paul Volcker in the early 1980s. So one, we've already had this recession. It wasn't the type that took the markets down 30, 40%. We got that in 2020. It wasn't the type that led the Fed to aggressively cut. They couldn't, Nathaniel, of course, because inflation was 8, 9% at the time. So one, we've already had a recession. At two, and this is the most important thing, the economy is not as weak as everyone seems to think it is. There's a lot to that, and I'm sure we'll unpack it in the conversation. But here's the thing. There's a lot of weakness and a lot of pain in America right now that's largely being felt by low-income America. But the honest truth is that the aggregate economic statistics pursued and produced by the likes of the Bureau of Labor Statistics and the Bureau of Economic Analysis and so forth, those measure the aggregate economy. And in the aggregate economy, one person does not equal one vote. In our electoral system, put aside the electoral college for a moment, but in our electoral system, we're voting for governor. If you had 100 people in the room and 51 say they don't like this guy and 49 say they do, that guy gets kicked out. And so right now, large swaths of the country are saying this economy is painful, inflation is ravaging us, and so on and so forth. The reality, though, is one person does not equal one vote in the poll that is the economy. Why? Here's why. Because if you look at the economy broken down into quintiles, the top quintile, the top fifth of earners in America represent 40% of consumption. 40%. The bottom fifth, Nathaniel, represent only 9%. So despite there being so much pain right now because of inflation, because of economic weakness, because of structural issues due to the hollowing out of middle-class America, along with the industrial manufacturing base in this country, parts like Appalachia look like absolute ghost towns that have been ravaged now by cheap fentanyl. Those places are hurting, but they're not showing up in the aggregate economic statistics. And so it's what's really become a K-shaped recovery. Think of what happened during COVID, right? Typically in economic recoveries, you get a sharp bounce back with everybody. Everybody, not everybody at the same rate, or everybody with the same amount, but everybody generally moves back up in terms of income, in terms of growth, in terms of job. But this time around, Nathaniel, it's a K. You've had those who have owned assets go up, those who have not necessarily owned assets, who need to rent, who aren't benefiting from low mortgage rates that got locked in 2020, 2021, they have gone down. And so it's a K-shaped recovery where those who were wealthy coming into the pandemic, who owned assets, have done pretty well coming out of it. Those who haven't, those who don't have the benefits of a fixed rate mortgage, those who don't have the benefits of having a couple $100,000 that's earning 4.5% clip in treasuries, have a couple $100,000 that's invested in a stock like Nvidia, which just keeps going up, up, up. Those people have borne the brunt. Full circle. We are not in a recession. The Fed, unfortunately, cannot cut rates or do policy for Appalachia or for Southern Alabama. They have to do policy for the entire country. And in doing so, they have to look at aggregate economic data because, for the reasons we just discussed and many, many others, the aggregate economic data is not signaling red, is not signaling caution. We'll get 75 basis points of rate cuts, I believe, starting here in September, with a 25 basis point cut in about 2 weeks. We'll wrap things up by the end of the year, and the Fed will largely be on hold for the foreseeable future afterward.
So you're not buying this talk about 50 basis point rate cut at the next meeting?
Right here, right now, I'm in the 25 camp. That's where the evidence is pointed. And of course, if the facts change, we have to as well.
So we got a couple things going on here. K-shaped recovery, the economic cycle continuing longer than people seem to be pricing in now.
Yeah.
But yet you do speak of problems in the economy. But how serious are those? Is there no chance that what's going on in, the blue collar America, the rural America, is going to, take its toll and impact the rest of the country? When will the economic recovery grind to a halt? These are all open questions.
These are all very open questions and no easy answers. To your question about blue collar America, when will it affect things? It will affect things. There's actually a date on the calendar. It's November 5th, 2024.
Sure.
That's when all of this comes to a head. And so in a sense, and that's kind of the cool thing about this, I don't know that it's cool, but it's fascinating to think about, is that even those folks at the bottom quintile who represent, again, they're the bottom 20% of the country. So they're 20% of the people, but they only have 9% of the impact on consumption. Every 4 years, they get an equal vote with the hedge fund billionaires of Connecticut and of Manhattan. They get an equal vote, and that vote is an election. And so they get to decide, are they upset enough with inflation? Are they upset enough with immigration that they are going to throw out the incumbent? And so to the extent that we're going to see a change, I don't think it's going to be the Fed responding to the woes and the real pain in middle and low income America, but it's going to be an electoral induced shift that's going to bring about a new policy set, perhaps as soon as January 20th.
You think that sounds like you think the Republicans will get the Congress and the White House?
I do.
Okay.
I do.
And then what would that bring? I mean, in terms of, obviously it would bring lower taxes. It would bring, well, I was going to say less government spending, but those days are over. It'll probably just, but what kind of opportunities would we be looking at there? I mean, other than, I guess, fracking oil and things like that.
Yeah. Well, we can talk about it in terms of the outcomes or how we get to those outcomes, but fracking is a good place to start. Thinking about using federal lands to tap into American energy and to pass those savings on to US consumers. Also, part of energy cost is what's going on around the world, right? When President Putin legally invaded Ukraine in February of 2022, that precipitated yet another round of inflation in the US economy, driven then by commodity prices. And so, to the extent, as is the case, that geopolitical weakness creates higher commodity, higher oil prices that are paid here at home, whether it's at the gas pump or for heating oil, for natural gas, then yeah, you've got to put in place leaders that are actually going to project geopolitical strength. And so, yes, more American energy here at home, less geopolitical volatility abroad, which brings in that geopolitical risk premium that we pay for with higher oil prices. But I've actually created a acronym that I think you'll appreciate.
Oh, yeah.
And what better way to think of it than the man himself, Trump. So T is tax cuts. R is regulation rollback. U is unilateral trade policy of the protectionist variety. M is migration curb, so curbing migration at the southern border, net immigration. And then P is power projection, projecting power, going into NATO and saying, we're out unless you're paying fair share, going to Russia and saying, don't even think about stepping one foot into Ukraine, going to Iran and saying, we're going to bankrupt you. Don't even think about doing what you need to do, about what you want to do to Israel. And so all of these, and again, you might not like it. You might bite your tongue. You might roll your eyes. You might complain to your mother-in-law about it. But at the end of the day, it worked. How do we know it worked? Because we didn't see the repercussions. We didn't see the type of chaos that we're seeing today in the 4 years under Donald Trump. And so I look at that, obviously, and maybe you can tell I'm an unapologetic conservative, but I look at this objectively and I say, look, I don't fall for all of we're going to see, the chaos that we saw and this, that, and the other. I mean, you have these Nobel laureate economists come out and say that Trump is going to be the worst thing for the economy since the Depression. By the way, these are the exact same arguments they were saying in 2016 when he was running. They literally copied and pasted them. There's almost no differentiation. And so yet again, it's the expert class proving that they're more about political loyalty than loyalty to something called the truth. And this leads me down this point that, I think we've largely conquered what the experts call inflation, which is the year-over-year change in the price level. So if you go to Walmart and you spend $100 in 2019, and then in 2020, or 2021, everything cost $170, let's just say, that's 70% inflation. And then if in 2022 you come back and there was 0% inflation, most Americans look at that and say, well, I'm back to 100, right? Like the bacon's cheaper again, right? No, you're still at 170. And look, I understand. I was an econ major in college. I understand what inflation is supposed to measure. But most Americans, when they view inflation as synonymous with the price level, and they still are deeply, deeply upset by whatever the cause is. I think we can talk about the causes, and I think they're largely at the feet of both the Federal Reserve, the Congress, and the Biden administration. Whatever the cause is, they're not happy about it. And you know this, that whenever something's going wrong in the status quo, in the economy, what's going on is who bears the brunt of that? It's the incumbent. And that here would be Vice President Kamala Harris.
Yeah, and so that's a lot of trades there that you could set up. I mean, just off the top of my head, you could short Mexico, short the peso, right? If you're talking about obviously defense spending, that just keeps going up anyway. But yeah. So, what other obvious type of trades would you set up here if you're betting on Trump?
Yeah. So we can almost go through the acronym again if you want to talk about it. I mean, obviously there's beneficiaries of tax policy, keeping the tax cut at low rates and then lowering it on a permanent basis with some of the exemptions there. We can get into the weeds there if you'd like. Regulation rollback, obviously that the key place that begins is with the energy industry. A lot of that goes through the executive orders. The obvious trade there is to be short oil, right? Also to look at some of the downstream beneficiaries. When energy savings are passed down, where do the consumers end up spending those discretionary windfalls over time? Is oil going to $20? No, but we've been in this range of $70, $80, $90 oil. Could we be in a range of $45 to $55 oil? Absolutely. And I think that's where we could get to on a sustainable basis under the Trump administration. Unilateral trade policy, like you bring up, Mexico, Chinese yuan. I'm a big fan of trading those things as they happen, as opposed to presetting some trades before the election. Obviously, there was a very outsized reaction to the Mexican peso in the lead up to the 2016 and the immediate aftermath of the 2016 election. there's been a huge depreciation in the Mexican peso recently, given the election of the leftist female president there. And so a lot of that move, I think a lot of the depreciation we would have seen has already been priced in. But look, as these things happen, definitely I think you also want to own volatility on currency pairs like the Chinese yuan, which will likely see a range of headlines, a range of negotiation, a range of back and forths with President Trump and President Xi's team in Beijing about what trade policy will look like. So you kind of want to own those oscillations in price. Migration, there's a lot of companies. This is not a popular position in the Republican Party, but I'll say it anyway. A lot of companies that have taken advantage of cheap labor because of the migrant crisis. When you get millions of poor, desperate people coming from all over the world, 189 countries represented in the past year at the southern border, they will work longer, cheaper, and more effectively than I guess we will, because we have some semblance of standard of living. And companies have taken advantage of that. And I'm looking at you, Uber. I'm looking at you, DoorDash, taking advantage of cheap immigrant labor. And so if you believe that we can get some semblance of closing the border, along with sending back a lot of the folks who are here, not even as an intentional act, Nathaniel, but something what we call self-deportation, that a lot of those benefits, a lot of that sanctuary status, a lot of the pull factors that brought folks here in the first place, if those leave, then those people are going to essentially show themselves the door because it's not there anymore. So if you lose Pearl status, if you lose work authorization, so on and so forth.
Yeah. Okay. So what is it? Let's go back to investing. Where does that? Where does one invest that?
Yeah, I mean, I would be short Uber. I'd be short DoorDash. There's large evidence that the vast majority of their workers they brought on in the past 36 months are cheap immigrant labor. They're exploiting people who are desperate, and they're paying them wages through this contractor system, right? That no other person who is not desperate would ever accept. No freely consensual person. So if they leave, and there's a lot of reason to suggest, as we've discussed, that they would leave and they'd be deported, or they'd self-deport, or they would not be coming here in the first place, or the stock and the flow adjustments, they're going to leave, and then Uber's going to have a problem. Holy crap. Our wait times are going to go up. We're going to have to increase incentives for new drivers. We're going to take a hit on margins, and you can imagine what the stock price would look at. So at Azoria, we're looking at interesting tactical bets around companies that have largely exploited immigrant labor. And one, I think it's wrong. I think two, it's bad business practice, because that labor is going to prove, to use a term, transitory if Trump wins.
Sick of me yet? Become a premium subscriber and avoid all ads or interruptions. Other benefits as well. Visit contrarian.supercast.tech for more information.
What do you make of the whole AI thing and the tech sector?
AI is real. If anything, it's not overhyped, it's underhyped. It's absolutely real. How do we know that? Because first off, a lot of the studies that are coming out there, a lot of people who are talking about AI this and AI that, who are downplaying it, are referring to studies that still to this day are using ChatGPT-3, that thing that launched nearly 2 years ago. They're not using Claude. They're not using 4. They're not using 4 Omni. Right here, right now, as we're on this interview, I can take this moleskin and I can sketch out a website, Nathaniel. Now, here's the bar to donate. Here's the bar to sign up. Here's my blog post, this, that, and the other. We could sketch the Azoria website right here on this notebook. I could take my iPhone, and then I could take a picture of it. And within 15 seconds, ChatGPT-4, the model available for free right now online, would turn that sketch into a fully coded website that I could then deploy onto a hosting service minutes later. There's no way that is overhyped, because no one's doing it yet. And so here's an interesting point. Is right here, right now, and you can look at the effects of this pretty easily. Look at the number of positions open for software engineers is down 70% from the peak in 2021. That's telling you that companies are already recognizing the power of AI to not replace, but to replace a lot of hours that are being used on coding to make it more efficient. Places like GitHub will tell you that 50% of code being deployed today is in some way, shape, or form aided by artificial intelligence, by Gen AI. And then the companies that stand to benefit from this technology, I think Microsoft is one. Everyone wants to find this really cheap, small or mid-cap stock. Look at Microsoft. They've got 1.5 billion active Windows 10 devices. They've got 350 million paid enterprise seats. And so it doesn't matter if I come up with Fishback Excel or Fishback word processor, whatever Microsoft does, mind you, they have a great partnership with Sam Altman over at OpenAI. They're doing great work with what they're doing with Copilot. They can then push this technology out to over 1 billion users, 350 million of which, Nathaniel, are already paying. So they have the existing device ecosystem, they have the existing enterprise ecosystem, and they have the pricing power. They have the pricing power to push through these new features and over time charge, and then get data, get feedback as a response. And so to everyone say, hype this on Gen AI, one, it's underhyped. We won't know the full effects of it. That's not to say, though, that prices necessarily have to track with the fundamentals. You'll remember that Amazon peaked in 2000 and then proceeded to go down 80%. It didn't end up reaching, I guess is the word, reaching its 2000 peak until 2012.
Wow.
What did Amazon do?
That's crazy.
What did Amazon do? This company that was overhyped when it went down 80%. Well, what did sales do? What did revenue do? It grew by double digits over that 12-year period. And so it's a perfect example that there's no such thing as a bad stock, only a bad stock price. And so I'll leave it to your listeners to decide whether the stocks they're looking at right now have fully priced or more than fully priced these expectations. I'm still a big fan of Microsoft. It's a company that's compounded at 22% over the past 5 years. This device ecosystem is barely being penetrated at this point. And ask people in your life, not the people who work at tech companies, but ask people in your life who work in white collar America. Ask them, are they using AI yet? Has their boss, has their supervisor signed them up yet? You're probably going to get 1 or 2 out of 10. That's going to be 8 out of 10 in the next 24 months. And guess what? That's all Microsoft, baby. That's Microsoft Office. That's specifically Excel, Word. Even if there were a better, and there isn't a better, but even if there were a better way of doing it, Microsoft has a huge moat in that enterprise workplace market. And I'm going to stay long until any of that changes.
Yeah, fair enough. I still hate Teams though, but I also hate.
I don't like it at all. I don't like it at all. But you know, it's like a political candidate. If you can agree with them 80% of the time, you vote for them. No questions asked.
But Excel, no one's been able to replace Excel. Like, I mean, there's some open source stuff that I guess.
Oh yeah, but that's a joke. And even if you went to your boss, even if I went to my former boss, David Einhorn, and I was like, hey, I got a better version of Excel, he'd like throw me out of there.
Exactly.
And be like, no, we're not doing that.
Yeah.
Right? It's just, these are the facts. Don't fight it. This is the system. It's deeply entrenched. Microsoft worked for 25, 30 years to build up this competitive moat. They have it. They own it. No one else does. They have paying users, unlike Google Docs. They have paying users. They have a partnership with OpenAI. They have a massive device ecosystem. You just have to be long the stock.
Yeah. All right. Speaking of hype, I have a few. Actually, I'm not sure what your thoughts are going to on this, which is why I want to ask it. Cryptos.
So, I would hope, in a meta sense, I would hope that my thoughts have been sufficiently scatterbrained that I've confused you with some of my positions thus far. I want to be somewhat independently minded, right? I don't want to toe the line in any predictable way that, oh, because he said this, I know that he'll say this next. So crypto is, I think, one of those examples. I'm very bullish on alternatives. I'm very bullish on decentralized finance because I'm bullish on this idea of capitalism. I'm bullish on this idea of creative destruction. I'm bullish on this idea of parallel alternative institutions, that when things aren't working, when you have serious concerns, especially in the third world, about money printing and about inflation and about sovereign default and sanctions and so on. We saw this recently with Russia getting their assets frozen, that crypto hedges for all of that. So that's a good reason to be bullish. But here's the thing. If you think, like I do, that Bitcoin and Ethereum adoption and crypto adoption writ large is going to increase steadily over the next decade, you don't actually have to translate that into price appreciation. Here's why. If I told you that more people are going to use the dollar 10 years from now than they do today, does that mean the dollar goes up? Does that mean that the dollar, I mean, more people buy Apple, right? Apple's going to go up. But does that mean that the dollar goes up? More people use oil goes up. Not necessarily in the world of currency. And you look at what are the purposes of a currency. One of them is a store of value. So as a necessary fact, Nathaniel, as Bitcoin becomes more widely adopted, it needs to become more of a store of value. And to become more of a store of value, it has to become less volatile. And less volatility is actually the way you express the long Bitcoin trade. The options market is sort of there. Let's see what happens with the options on this BlackRock ETF. Hopefully we'll get those here in the next couple of months. But I'm bullish on the technology. I'm bullish on adoption. It's just not clear historically that that translates into price go up. I actually think that vol go down as the currency becomes more widely adopted. You're going to get fewer 10%, 20% moves one way or the other. You're going to have folks standing in and slowly but surely depressing the price range because the dollar doesn't move 20% in a 3-month period. And neither should Bitcoin as it becomes more widely adopted. And so that's where I stand. Bullish on the tech, bullish on consumer adoption, but not clear on what that actually means for price. I would effectuate that view through short vol positions in the current in Bitcoin.
That's an very interesting point. Yeah. All right, James Fishback, I want to take a short break.
Cool.
And we're going to come back, ask you some more about yourself, your firm, your interaction with David Einhorn, if we can.
Sure.
And some other things. But let's first take a quick break. If you are a premium subscriber, you will not get the break. Don't touch the dial. We'll be right back. In fact, we already are. And everybody else, to become a premium subscriber, visit the website contrarianpod.substack.com and sign up.
We hope you're enjoying this episode of the Contrarian Investor Podcast, where we give voice to those who challenge a prevailing narrative in global financial markets. Consider becoming a premium subscriber. For $9 a month or less, premium subscribers receive a number of benefits. Podcasts are posted immediately after they're recorded. Transcripts are made available within 24 hours. Premium subscribers get direct access to the host, and of course, there are no ads or interruptions. Visit contrarian.supercast.tech for more information.
By the way, you don't need the .tech suffix to get to that website. .com will do the trick. And we also have a Substack that where you can sign up for the same prices, same benefits, same details, contrarianpod.substack.com. So if you already have a Substack account and use it, or have the app and use that, that's probably the best way to go. So contrarian.supercast.com or contrarianpod.substack.com. Whole bunch of benefits, including, of course, getting this episode up to a week early without ads or annoying announcements. And you also get the daily Contrarian briefing and podcast that is released every market day morning at 7 a.m. This is a Contrarian take on the events of the day ahead and what is likely to move markets, such as economic data releases, earnings, and other things. It is really good, and that is completely unbiased, of course. So check that out, contrarianpod.substack.com or contrarian.supercast.tech. Now on with the show. James Fishback, head of Azoria. I'm going to ask about the name there in a minute. Also CIO and head of Global Macro. But this is the segment of the show where we ask our guests to tell us more about themselves, how they came to this station in their investing career, how they got started in their investing career. Most investors have an origin story, to put things in Marvel terms. What is yours, James?
My investment story, it goes back to college. I was doing research my sophomore year. This was in 2014. About the price of volatility. So equity vol, rate vol, FX vol got really, really low. I mean, 20, 30-year lows in the summer of 2014. And I went to not a family friend, but the mom of a friend that I knew from high school debate, which is a really flat world. I was a high school debater. And it's the place where, and me, the son of a bus driver and an immigrant, would compete against the son of a very wealthy individual. And I went to her and I said, I have some ideas about this. I don't know much about it, but I've learned about how to structure these trades, and I'd love if you could put some money behind it. And she did. And then we made money on that trade a couple months later. And for the next year, she kept putting more money behind the strategy that I was running. It was largely US based, FX rates, equity vol. And then at the end of 2015, she had over $3.5 million invested with what we were doing. And she said, I want to bring some friends along. I want you to start a hedge fund. But I want you to leave college to do that. And so I did. I stepped away from college. I went out and raised about $15 million for this hedge fund that I called Macrovoyant. I ran that for 5 years. And then when I was running that hedge fund, I just out of sheer desire to share ideas that I had and get feedback, I would message people on Bloomberg. You worked for Bloomberg, you could pretty much message anybody. You could message Buffett, you could message Einhorn, you could message anyone. So I messaged Einhorn along with a few others, and I would share ideas from time to time. And in the spring of 2019, the Fed was about to embark on a pretty aggressive rate cutting cycle. And I told David, here are some trades to play that. And he put those trades on to give me credit, to give him credit. I sent an idea, the exact trade. Here's the symbol, this futures contract, do this. And then a couple of weeks later, the trade made $2 million and he sent me a check for 20 grand. I'll give you 1%, he said, of the profits. And that began a relationship with a guy I really looked up to as a college student, read his letters, read his book, followed his thinking. Disagree with him on Tesla, but that's okay. And we worked together pretty closely in 2019 on different macro bets. And then 2020 came around, and wow, that was a year to be involved in macro, with what gold did, with what oil did, with what the VIX did, and so on. And so we went from probably talking maybe once every 2 weeks to talking multiple times a week, putting on several trades a week. And we did that in 2020. And then he offered me a job at the end of 2020, which I gladly took. As a college dropout running a hedge fund for 5 years, I wanted to size up what I was doing, spend more time solely on investing than actually running a hedge fund business. And I joined Greenlight in February of 21. I spent 2.5 years there, left in August of 23, as it turns out, in hindsight, rather eventfully, and launched this new firm called Azoria, which is named after an archaeological site on the island of Crete that dates back to the early Iron Age. I've always been fascinated with that part of the world. I also think it's a pretty cool name. And what Azoria is it's an investment firm that does a couple things. Traditionally, we're running a private global macro hedge fund. But next year, we're launching a series of new innovative ETFs that are unlike anything that's available in the market today. I'm motivated to do an exchange traded fund because I'm motivated to create a product that all Americans can access, not just high net worth individuals, not just billionaire family offices, but whether you're a nurse in Coeur d'Alene or a firefighter in Cincinnati, if you've got a couple $100 that you want to put behind our strategies, you believe in what we're doing, we'd be honored to take that hard-earned money and maybe make it a little bit more. So that's what Azoria represents, and I'm excited to be doing it. We're all about free thinking, all about rejecting not necessarily the status quo for the sake of doing it, but really getting to our conclusions because our own rigorous analysis got us there, not because we're taking anybody else's word at face value. We're about meritocracy. We believe that you have to hire the best, you have to invest the best way, and you have to just look at things as they are. And we believe in a little thing called excellence, which is that it doesn't matter what the S&P is doing in any given year, we have to focus on our returns. I don't take any pleasure if the S&P is down 18 and we're only down 14. I want to deliver consistent excellence to our investors, and that means a steady stream of positive returns.
Wow. Okay. How is the ETF going to work? And is it going to trade? It's going to be a macro strategy, so trading rates and currencies and stuff, or is it going to trade stocks?
So the ETFs will be thematic. I think we're going to get to a macro trading ETF once we have a better chance to explain what macro trading is. And I don't think there's a ton of demand right now in the market. What I do think there's more exciting opportunities in what we actually call our first ETF, which is called the Meritocracy Fund. And so very simply put, what it is, Nathaniel, is if you take the S&P 500 and you exclude companies that have mandatory racial and gender hiring quotas, which is to say they're not hiring on skill, ability, and expertise. They're hiring on superficial qualities. And we can disagree politically, and your viewers can as well. I think that any constraint on a company is a bad thing. I don't think that a company should come out and say that we're going to hire 40% of our executives are going to be minorities, as much as they would say 40% of our executives are going to be mathematics professors. Any constraint that binds business to anything other than make money would effectively prevent them from exercising maximum flexibility and making the right meritocratic decision. And so 500 companies in the S&P 500, technically it's 504 individual securities because Google and News Corp have Class A, Class B. But that's besides the point. 500 companies, we're going to exclude those that have mandatory gender and racial hiring quotas. and we're going to let folks invest in meritocracy. Companies that, yes, may have a DEI program, that may have an affinity group. Not personally big fans of those things. I wish companies would embrace this idea that we are all Americans, that all lives matter, that we're all part of this giant melting pot, but that's okay. We're focused on DEI practices that actually affect workforce quality, workforce turnover, competitiveness, training costs, et cetera, that sap up resources. We learned from the New York Times, of all places, Nathaniel, 2 years ago, that Wells Fargo was interviewing minority candidates, wasting time interviewing minority candidates to check that box for positions they had already filled with white candidates. And so even if you're a super progressive, even if you're someone like myself who believes that there are situations where people should get opportunities to get jobs that might not otherwise be available to them because of their socioeconomic background, because of their history, whatever the case is, not on some blind system of, you're black, you get this, but on merit, that even if you believed that, you have to be really upset with a system that says you don't matter. You don't matter so much that we are going to have you prep for an interview for a week. We're going to tell a single mom from Baltimore, take off of work for a couple weeks, prep for this interview, and we're going to look you in the eye and ask you questions as if you have an actual shot at this job, when you and I both know that you don't, because we already gave this position to a white guy from Connecticut. That is wrong. That is un-American. That is unethical. It's immoral, and it's awful for business. And so our research in this space has already found that these companies that have adopted these policies, by the way, have imposed them on themselves, are already underperforming their peers and will continue to underperform your peers. Ask your viewers, do you want to invest in a local pizzeria that hires the best bakers and cooks and waiters, no matter what they look like, no matter who they love? Or do you want to hire a pizzeria that is just hiring people because of the color of their skin and because of their sexuality and gender? That's the question. And I think most people, Democrat, Republican, Independent, are going to want to invest in a business, whether it's as small as a local pizzeria or as large as a multi-billion-dollar S&P 500 company. They're going to want to invest in the business, Nathaniel, that actually hires on merit and merit alone.
So hang on. So it's not just selling anybody who has a DEI practice. It's specifically, right? That won't disqualify it. But what you're looking for.
No. And it's because it's hard to quantify that. And by the way, every single S&P 500 company has some flavor of DEI. I roll my eyes at it, but it doesn't actually have a real downstream business. I think it affects corporate culture. But again, I'm a realist here. I'm objective. Having a DEI program doesn't really affect your bottom line in the way that having we're going to hire the next 30% of people we're going to hire have to be minorities.
Okay, so companies that have specific hiring quotas, for lack of a better word.
That's right.
Okay. And there are companies out there that do that. Or maybe they have a promotion policy that they only promote certain genders or something like that.
Yeah. So there's 24, right? There's about 24 companies that fit this test. I mean, there's so much wrong with this. I mean, there's the immoral, there's the unethical. Obviously, that matters less so as an investor. But to think that someone's skin color makes them a qualified candidate as opposed to skill, expertise, and ability, that is a massive, massive backfire, a massive business disadvantage for them to accept. And so to the extent that new hires are less qualified, you're going to see higher turnover. It's called imposter syndrome. You're going to see lower and slower product and service velocity. You're going to see the hiring process focus on something that actually requires higher training costs. You're going to see candidates that are roped in on the HR side and on the real business side. You're going to bring in separate people to interview, and that's going to take people's time away from their day jobs to make money for the business. And so all of that is to say that these companies, and we're going to be out very soon with a white paper on this at azoriapartners.com. That is to say that all of this is wrong. We're already seeing this started really, as you could imagine, in the summer of 2020, after George Floyd's death. This has already led to a shocking level, and we'll share it soon, a shocking level of underperformance in these companies. And by the way, they run the gamut in terms of market cap, in terms of employee size, in terms of industry, in terms of product versus service, right? These are not all the same type of company. So you can't chalk it up to, well, these companies are very similar. It just so happens that they also happen to be have hiring quotas. This is just the beginning of a massive, massive underperformance. So what we say to investors when I talk to people, I say, don't let your retirement money be invested in a social engineering experiment that is already failing. Buy the S&P, exclude the woke, and thank us later.
But it's interesting that there's so many different, woke, if you will, programs at these companies. There's ESG. You remember that? It's kind of gone out the window now. But you're specifically focusing on this. And all of these can be very costly, by the way. Like ESG can be, unless it's just window dressing, right? Yeah. But I guess what you're saying is you're okay if people just doing this DEI stuff or ESG for marketing purposes, and it's not a big upfront cost and it won't affect their whole, value stream, I guess. But if they're hiring specifically based on these quotas, then that would make them a short, basically.
Not a short.
Okay.
We don't want to short these stocks. A lot of
them
you can't high borrows, right?
Okay.
It's just a question of underperformance, right? I think that the tide's going to lift all boats. The U.S. economy is going to continue to, because we have entrepreneurs, we have just such a great spirit here. We largely have free markets, but it's not a short, but it's definitely an underperform.
Okay.
And I think a lot of people who talk to us, by the way, they say things like, look, the underperformance, you had me at underperformance, but you know where you really have me? In my conscience, I don't want to put my retirement money. I don't want to put that money into a social engineering experiment that punishes anybody. And by the way, this idea that it somehow rewards one group and punishes the other, it hurts everyone. It hurts everyone that when you say the next person you hire is going to be a Black woman, that when that woman who is maybe extremely qualified, very well maybe extremely qualified, Nathaniel, comes into the company, constantly looking over her shoulder, constantly having the water cooler gossip, that she is only here because of the color of her skin. That is wrong. It is un-American. Frankly, it's illegal. But in the meantime, in between time, we are not going to wag our finger and write op-eds and write mean tweets about this. We are going to give investors the first chance ever to exclude companies that engage in an awful business practice known as hiring quotas. And by the way, I'd be against this if it was any type of hiring quota. Think about this as just an example, right? Any type of constraint. 40% of our employees must know how to swim. Sir, this is a tech company. Why does that matter? Why would you impose that constraint? Right? Okay, right? So we agree, not good. 40% of our new employees must be vegetarians. Sir, this is Chevron. Why would that matter? Okay. 40% of our board members must know how to do the Macarena.
I mean, that's not hard.
It's not hard. Sir, this is McDonald's. Okay. You need the Macarena at Waffle House when you're dodging the late night alcohol-ridden patrons who come in, and you don't want to go to a Waffle House at the wrong time of night. I typically go around 6 p.m. to tell you the truth for dinner.
Sick of me yet? Become a premium subscriber and avoid all ads or interruptions. Other benefits as well. Visit contrarian.supercast.tech for more information.
Any other opportunities here in markets? Anything else you're excited about?
I'm excited about a guy by the name of Javier Milei. I'm excited about what's happening in Argentina. I got a chance to meet him earlier this year. I was an advisor to Vivek Ramaswamy's campaign. Got a chance to actually introduce President Milei to my friend Vivek in Spanish, my mother's native tongue, one that I wasn't taught as a kid. I was yelled at as a kid, which is a pretty good way to learn a new language. And what he's doing there is incredible. He is pursuing a radical agenda, but unlike the radical agendas being pursued in other developing countries, one that is radically free market, restoring the central bank to sound reform, doing something we like to call privatization, that if the private sector can do it, the government shouldn't be doing it because the government does an awful job at things that the private sector can independently do. Bringing down inflation, making it a country where you could actually invest in and have confidence that those investments would not just be protected from inflation, but would actually be safeguarded by the rule of law. There's a once in a generation opportunity to invest alongside President Milei's vision for Argentina. And as he told Vivek when we met, make Argentina great again, restore it to greatness. There is an unbelievable opportunity there. And we are in the first inning of an incredible run up in some really certain Argentinian stocks. And so we're looking at that as well, whether it makes sense for us to launch a fund that would allow, again, the first of its kind, to invest specifically in Argentinian companies that stand to benefit directly from President Milei's extraordinary vision for this country.
Wouldn't all of them? I mean, wouldn't that you just buy the ETF and the index and away we go? Or are there some that are government? Yeah.
Yeah, I don't think you couldn't go wrong buying the ETX, and there's an ETX out there for the Argentinian stock market. But much like you couldn't go wrong investing in AI by just buying the S&P 500, I think that's a good bet. There's still something called the Magnificent Seven, right? And the Magnificent Seven ETF, put together by my friends over at Round Hill, that is a direct pure play to these market leaders. And so, look, you can invest in the Argentinian stock market. There's an ETF for that. But much like Round Hill has developed the Mag 7 ETF to get a pure play on these market leaders, we're going to develop an ETF that gives you a pure play on Milei and what stocks stand to benefit from his free market agenda in Argentina.
Cool. All right. That's interesting. Off the top of your head, what sectors do you think would do well?
So banking is an interesting one. Infrastructure, which is largely run by the government. So if you privatize that, there's a huge opportunity there. We're going to share a lot of that real soon, a detailed white paper on not just the stocks, but the economic reforms in place. I think people want to understand the macro. We're saying that I was the macro guy at Greenlight. I was the macro guy for 5 years when I ran a macro fund. I'm a macro trader. But when I think of macro, I don't think of just trading interest rate futures on what the Fed's going to do over the next 6 months. When I think of macro, I think of big picture. And what's bigger picture than a visionary leader like Javier Milei coming to Argentina, shaking things up, making capitalism great again in Argentina, and looking at the stocks that stand to directly benefit from that policy vision and that policy action. And so macro for me is not exotic derivatives, although I've spent plenty of my time doing that. For me, what's really exciting about macro is big picture bets around geopolitics, around the economy, around policy change, and then giving everyday Americans the ability to tap into that in a new and unique way.
Cool. All right. Any other areas geopolitically that you think are exciting other than the U.S. and Argentina?
I think from a long perspective, those are it. I think Israel, to the extent that it matters, and it obviously does, it's the startup nation. We're going to continue to see it's punched above its weight. I am inspired by the just Israelis from all over who have stood strong as we come up on the 1 year anniversary of this heinous attack on October 7th. And so this is more of a gut feeling. I haven't particularly looked at any Israeli stocks recently, but this is a country that just continues to prove that it is the most resilient in the face of adversity. And I'm inspired by what's happening there. And I think anytime you see that kind of resilience in a people with an extremely long and impressive track record in business and finance, you want to look very closely at that.
Yeah. I mean, Warren Buffett says, don't bet against America.
Yeah, I agree
right
with him
there,
100%.
right?
And America's at the top of that list. No question about it. That's why the best bang for your buck is owning an S&P ETF as the largest part of your portfolio. I do think, though, that people want to be invested in this vision of Argentina, want to be invested in this vision of Israel. And so we're going to create products for investors to have an opportunity to directly tap into markets that there's already a hunger for. There's already hunger. I mean, everywhere you go. I mean, I'm in a lot of Hispanic communities because I live in South Florida, right? Travel the country and so on, right? But most people see Milei and they say, I want a piece of that. I want to own something that's going to go up in value as he makes history in Argentina. And Azoria is putting together that product as we speak, and I hope to share more about it soon.
Very cool. All right, that is a nice way of closing. James Fishback, thank you for joining the Contrarian Investor Podcast today. Maybe in closing, tell our listeners how they can find out more about you. I just saw you are active on the social media, and more about the firm, websites, etc. And we'll put all that in the show notes as well.
Well, easiest thing is on a platform called X or LinkedIn, just James Fishback, just how it sounds. And our newsletter, headofmacro.com. That's where all of our updates for Azoria are coming out. Our most recent newsletter, you might like this, Nathaniel. It's called Markets Are Weird, to use a term that's very popular these days. Markets are weird, but the Fed doesn't care. And that was a response to the blow up in early August that led a lot of commentators to say they got to go 75 and they got to do it yesterday.
Very cool. All right. Now that's great. That's great. I'll link to all of that. Thank you all for listening today. Thanks to James for coming on. Best of luck with the new venture. And we look forward to speaking to you again next time, probably in a couple of weeks or so. See you then. Bye.
Thank you for listening to the Contrarian Investor Podcast. We hope you enjoyed this episode. To subscribe to this podcast, simply open your favorite podcast software and search for Contrarian Investor. Follow us on social media by searching for Contrarian Investor on Twitter and Instagram. Send us your thoughts on feedback@contrarianpod.com. We look forward to speaking to you again next time.